In this video, traders, we're going to talk about the one shady practice that I keep seeing traders who are selling systems doing. Stay tuned. Hey traders, everyone, welcome to you. All right, so I keep seeing this, and you know what? It's actually annoying me because I think that a lot of people are being taken for a ride from this, and I constantly see this. We've seen this for years. I've seen a couple of them recently. I'm not going to kind of name names and stuff because I've not done enough due diligence and research to be able to call these people out. However, I've seen this a lot of times, and it's a shady practice. It's verging on being deceitful, and whilst we're not in the element realm of fraud, it really is pulling the wool over beginners' eyes. So this is really people who are selling a system or a strategy or a follow me type account. So in other words, hey, this is how I'm trading, this is what I'm doing, I'll give you the signal or you follow me and we'll make money together, this kind of thing. And of course, there's plenty, by the way, this has nothing to do with that. There's nothing to do with signal services. I think there are some good signal services out there that can be beneficial to traders if used in the right way. There are good copy trading services out there. Again, some of them are good, some of them can be used to be of benefit. All these things, there's good in everything, but this is the wrong side of it. So how does it work and what's going on? So really, what people show is this. They go, right, here is my equity curve, guys. Aren't I great? So they have this curve that just goes up and up and up and up and up like this, and it looks fantastic because you think, wow, look, all this money they're making here. So it's all the money they're making on this axis all the time. It's how long it's been going, and it's been fantastic, and it looks really good on the face of it. But when you dig into the actual strategy, all is not what it seems. And yes, that may well be a realized P&L account. And let me just note that down, guys, because this is the wording that we are looking at here. Realized P&L. I know you guys over in the pond spell it with a Z, but we spell it with an S over in the UK. Realized P&L. Now, what they are doing is generally it's Forex. And generally what they're doing is they're using things like a 15-point target and 1,000, I'm going to say point, but it could be pip, stop. It would be pip, obviously, if we're talking about Forex. So 1,000 pip stop, 15 point, 15 pip target. Use points, obviously, that's if you're trading the DAX or you're trading FTSE or a Dow. But generally they're trading on currencies. And so what this means is, your chance of being stopped out is very, very slim on this trade, right? Chance of you getting 15 points is quite high compared to being stopped out. Fine. But then you might say, yes, well, that makes sense. But what happens if they just get it wrong and it goes and goes and goes against them? Eventually they'll get stopped out. Yes, but there's another dimension to it that these guys do. They will add to the position at increments on the way down. So in other words, they'll put one unit on at, let's just make up some examples here, 1.015. Okay, they'll put one unit on, so let's put a 1. Then they'll put another unit on, let's say at 1.005, so 10 pips lower. Now they've got 2. Then they'll put another unit on lower, so 0.095, so put another unit on lower. If the market pops back up, then they'll take their profits and they'll get out of it. If it doesn't, they'll keep adding to the position as it goes lower and lower and lower and lower. Now, because they're in a relatively small amount, they can afford to do this. And most of the time, the market is going to pop back up and take them out at their 15-point target or break even or a small profit normally, because they want to see that percentage. Most of these guys are kind of saying, oh look, we've got a 98% success rate, some number like that, and it looks really good on paper. So they want to take some profit, but in reality it's going lower and lower. Now, that means that the unrealized P&L is normally substantially negative because they'll do this across multiple currency pairs, and the markets may go against them. That isn't a crystallized loss yet, so it doesn't go on this chart, because theoretically this chart is realized P&L. Now, if you were to plot an unrealized P&L chart, the story would be very, very different. It would be dramatically down followed by recovery, dramatically down followed by recovery, and in actual fact you would probably find, or possibly find, that this is actually negative because there's a few unrealized losses that are sitting on the books that haven't yet been taken. Now, this is irrelevant, guys. If you're sitting on a huge loss, let's just simplify things for a moment. If you're sitting on a 50 grand loss on a trade and you're making 100 quid here and there, it doesn't matter how many of those you make, you're still sitting on a 50 grand loss. It still comes out of your same bank account, or the same trading account, should I say. So this is the game they're playing. And what happens is, very rarely all this, because they've got such a long stop, such a wide stop, that okay, if they do take a hit, it damages that, but they rarely do, because they'll just keep adding to it almost indefinitely and never take the loss. And so this unrealized, if they're on the wrong end of stuff really badly, eventually they will get stopped, but they get so much time because they're scaling in and scaling and scaling in and keeping this unrealized losses on the books. However, a lot of the time, depending on the market conditions, the market rotates back up and they get away with it. They're adding. The market rotates back up over the next month and they manage to scale out and they manage to make a profit. And the point is as well, guys, is that what they will do is they will, of course, take profits on the lower ads to boost that realized P&L. So this example here, let's say this now pops back up to 05, 10 pips up, you betcha they'll mark that down as a plus 10, take that off the books, leave that as an unrealized loss on the book, but that doesn't show in the realized P&L. They've made 10 pips, aren't they geniuses? Goes down again, goes down, oh, keeps going down, keep adding, pops back up. Oh yes, look, we've made 20 pips from these two trades, aren't we geniuses? Bang, ka-ching, growing the cash register. But in reality, the unrealized loss is huge. And if you do that over a number of different pairs, you can make this look very, very attractive to the person who's not digging into the strategy. It looks very attractive. A nice upward curve, a nice high percentage. It looks like steady gains coming in, ka-ching, 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 nice steady gains coming, pips flowing through the door. Looks great. Take my money, I want to sign up for it. But when you dig into it, very often these unrealized losses are sitting on the books. The strategy is to add until it pops up, get the gains on that, keep that unrealized loss, add. Because in theory, you could keep doing that. That could be on the books for, you know, a year or something. You couldn't go 1,000 points against you and you're constantly changing the rotations and then you get another one that's been on there for a while. You get the point. I think you see what I'm getting at. I've seen this a year ago, guys, where this was his equity curve, plod. It was doing very nicely. He had so many people talking about it. It was all over in the retail space. Everyone thought that's a genius guy. But when you looked at his trades, you could see exactly what was happening. This was the same kind of thing he was doing. This guy was only trading on one pair. Now the latest thing is they trade it on multiple pairs, so they can say, oh look, you know, we've made 1,000 pips on USD JP. Well, yeah, but you've lost 10,000 on Euro US dollar, you idiot. You know, it doesn't make any sense. So anyway, ultimately what happens is when they start to have to book these, whatever reason, off the market just suddenly goes, and they can still make a mess of this. You can go on for quite a while making this look nice and pretty on paper, but eventually you can still make a mess with it. And what happens is you get this, just bang. And that's exactly what this guy's equity curve looked like. Plod for years using this, and he was just literally running through a minefield, and he ended up getting caught on a big move that went against him. He was adding too early, and all of a sudden, literally within, I don't know what it was, within weeks, guys, undone all that work. It was something like 10,000 pips and went down negative to minus 5,000. Something ridiculous. The point is, watch out for this. If you're interested, and again, I'm not saying that all these people doing this all these people selling signals or systems or follow me stuff are doing this. By no means is that the case. There's some good ones out there, as I alluded to earlier. However, if you see something that looks a little bit like this, if you see the numbers a little bit high like this, just have a little dig into it. Just have a little dig into the system and see if this add. If there's lots of little trades on the same instrument at very similar levels, and you just see stacks of orders going filled, and you think that is suspicious. You know, there's no genuine strategy that would scale in that much all the way, and you like reams and reams of these orders and then be popping it off as it pops up. That is not sustainable, because that's eventually what happens to you, because you end up keeping all these unrealized losses on the books. And ultimately, guys, if you're following it, that's still reflective in your P&L. You can't just go to the bank and say, hey, look, I've got my realized profits here. Yeah, but it doesn't work like that. We know if you're trading on a live account, or if you're trading on a demo account, you're new to trading, you know you've got your money in the account there. The unrealized and the realized is reflected in what's available there because it's a mark-to-market situation. You can't just pick and choose and say, well, I may have a couple of offside positions here, but I've made so much this month. Doesn't work like that, which unfortunately what some of these guys are doing. So be careful with that if you are considering signals or if you are considering a follow me type strategy, platform, etc. Just be wary. Some good guys out there, but people doing this should be avoided. Take care, keep your risk manager, whatever you're doing, guys. See you next one. Bye-bye.